what we're going to be looking at here is acquisition or construction costs of property, plant, and equipment here, and what would be related directly to the acquisition or the construction here of our plant and our equipments here. And we're just going to have a listing here of what would be included here. And what it is before here is for bringing our property, plant, and equipment to the location and condition necessary for its intended use. And this would be during the construction or acquisition period here. And what we're going to be looking at here is for property, plant, and equipment that's acquired here for the use in operations here and not for resale. It's going to be this property, plant, and equipment is long-term in nature and is usually depreciated, and it has a physical presence here. So the accounts that we're going to be looking at here, we'd have a land account here, land improvements, a building account, and then a machinery and an equipment account. And then we have one other item here when we're dealing with this construction period here or acquisition period. It's our capitalized interest. So let's go up here and start with our land account. And again, this is just the specific items that would be included here when during the acquisition or the construction period here. And land is not depreciated. The other accounts here or other items here broken down in our property, plant, and equipment would be depreciated. So starting with our land account here, to get the land ready for use, and again, in this case, the land has indefinite life here. It's separated out here because it is indefinite life. Number one here, your purchase price, that would be the amount paid here. Number two here, closing costs, that would be like our title search, professional fees, attorney's fees, recording fees. And then we'd have encumbrances on the property. That could be like our assumed taxes, attached liens here, assumed mortgages, assumed other liabilities here, and assumed any property taxes upon the purchase here of the land. And then number four here, we had a cost to get the land ready for use. That could be for removal of the old buildings here. And that would be like the demolition here of the old building here, less any salvage values. That would reduce any of our land cost here, any salvage value here. And then we would also have like grading, filling, draining, and clearing the land. And then it would be any additional improvements which have indefinite life. And then we would have special assessments on the local improvements here. That would be like our pavements or our streets or highways out in front. It'd be streets, lights, sewers, drainage, and that is considered long-term here because it's maintained by the local governments here. Now going up here and looking at our land improvements, we break that out here separate from our land here, and because these things have limited life here. And again, to get the land ready for use here, that would be like installing fences, parking lots, private sidewalks, landscaping, and so forth. And then we have our account here in capitalized interest here. Well, that's a special subject here, but that the interest included, it would be included here in our capitalized interest would be debt interest only debt interest here. There wouldn't be any interest on equity stock or interest, none there. And then we would have between the land and buildings, for the land and the buildings here, we take the lesser of the avoidable versus the actual interest. And then if there's any revenue wouldn't be included here, like that would be interest earned on the amount of money that we have sitting in an account here until we make payments against our equipment or our plant or our land here. And then let's go up and look at our building account here. And again, this is getting the building ready for use, and it could be also self-constructed buildings. And that would be like the purchase price if we buy the building here. If it's self-constructed or we build it ourselves, it would be our material, our direct labor, and overhead. Well, that's depends here if you decide to charge overhead or if you don't charge overhead. And then it would be repair charges, any alterations, the building excavation here, that is like digging the hole, getting it ready here for putting up the building, any professional fees, permits and licenses, architect's fees, any insurance premiums here during the construction period, or any temporary structures that have to be built for the construction of the building here. And then any property taxes during the construction period here. But you do not include any organizational expense or promotional expense or any interest revenue here. And then for our machinery and our equipment account here, again, that's to get the machine here ready for its use, and it could also be for self-constructed machinery here, or equipment. Purchase price, that is amount paid here if you purchase the equipment here, and if you self-construct it here, that would be your material, your direct labor, and any overhead. Well, that again, that's optional here. We can look at that down below here. And then we'd have any freight and handling, taxes on the purchase, any insurance here in transit, and any insurance on the equipment here, assembly or installation here of the equipment, any special foundations to put the equipment, machinery or equipment on here, any testing and startup costs. This is the cost getting this machine ready here for its intended use or its production use here. And again, that could any break-in or startup costs as well here. Any cash discounts. Well, if we're offered a cash discount here on the purchase of the machinery and we don't take the discount, then it would reduce the price here of the machinery here. And then again, any material or direct labor that would be required here, and variable overhead. Again, that depends if you want to charge it or not here. And then for self-constructed assets, you would have the fixed overhead options here. Again, we're talking about overhead. Either no, you don't use any fixed overhead versus using a portion of the overhead, or you can look at full costing versus a portion of your overhead, or no overhead at all. But all I've done is gone through a list here, and this is what would be included in our property, plant, and equipment here. Again, we have this land account. We went through that here. And then our land improvements, remember, those were items here that have limited life here. And then again, we had our capitalized interest account. You can look at that here. And then again, our building, that is what you put on the land here for our property, plant, and equipment. We looked at that here. All right. And then our machinery. You can see that here. Okay, so that takes care of what would be included in our property, plant, and equipment here during the acquisition or the construction period.